Hello, this is Nick Giardina from MCOL, and I would like to welcome our listeners to today's podcast session. We're pleased to have Doug Sherlock, Senior Healthcare Analyst for Sherlock Company, joining us today. Doug is here to give his quarterly insights into financial markets of health plans.
Thanks, Nick. In this podcast, we'll review the performance of the managed care industry for the second quarter of 2018 and year-to-date. We'll also discuss sector valuation indicators and operating trends. First, I want to speak to stock prices and valuation. As of August 14th, stock prices for the publicly traded plans are up by an average of 26% since the beginning of the year. This compares to the 6% increase in the broader market measured by the S&P 500. Health plan sector market capitalization has increased by 17% year-to-date. The stock prices for 7 of the 9 plans gained ground year-to-date, led by the Medicaid concentrated plans. Molina appreciated by 75%, followed by WellCare at 45% and Centene at 42%. Humana increased 33% and United Health gained 20%. Anthem was higher by 18% and Aetna by 10%. Cigna and Triple S were lower so far this year with a decline of 9% and 2% respectively. The more sanguine investor sentiment, combined with an average 14.7% growth in net income, are likely factors in this appreciation. Valuation metrics were higher since the beginning of the year, with price to trailing 12 months earnings higher by 15% to 24 times, and price to operating earnings increased by 16% to 16 times. Price to sales increased by 13% to 0.8 times, and price to total member gained 20% to $2,900 per member. And price per risk member grew by 28% to $5,200 year-to-date. All rates of change are calculated holding constant the universe of health plans in both periods. Since our podcast in late May, the average health plan stock prices are higher by 19%, with health plan market capitalization higher by 16%. The S&P 500 gained 4% since May. Health plan valuation metrics also trended higher. So, on to our review of operating trends. For the second quarter of 2018, combined ASO and risk membership grew by an average of 2%, while increasing by 1% in total to 153 million members. By average growth, I mean the average of each plan's growth rate. Total reflects the change in combined membership of the plans. Fully insured risk membership decreased by 1% on average, but in total grew by 1% to 78 million members. Medicare plans had a decrease in membership on average by 3% to 17 million members. Molina led Medicaid-focused enrollment declines with a loss of 587,000 health insurance marketplace members. Commercial plans, however, experienced a 0.2% average increase in membership and a 2% total increase to 61 million members. The proportion of members served on a self-funded ASO arrangement decreased by 0.2 percentage points to 48.7% of total members. Self-funded members totaled 75 million, which was higher by 9% on average and up by 0.3% in total. The 2018 second quarter revenues increased for 7 out of the 9 plans. Revenues rose by 6% on average and 8% in total to $141 billion. Medicaid plans earned revenues of $24 billion, posting an average and total growth of 8% and 11% respectively. Commercial plans experienced a 6% average increase in revenues and an 8% total increase to $117 billion. Premium rates for all plans increased by an average of 8% to $498 per member per month. The average Medicaid plan premium rate increase was 11% to $430 per member per month. Commercial plans experienced premium rate increases of 6% to $532 per member per month. Anthem had the highest increase at 11%. Premium growth does not adjust for product mix or for benefit design changes. For instance, the widespread shift in favor of Medicare Advantage likely increased the apparent growth in expenses. Year-over-year quarterly operating earnings trended higher for 5 of the 9 plans. For all plans, operating earnings increased by an average of 197% and in total by 5% to $9 billion. Medicaid earnings of $960 million reflected an average increase of 530% and a total increase of 72%. Molina's second quarter earnings increased from $19 million to $318 million on an improved health benefit ratio. Commercial plans reported an average decrease of 3% and a total increase of 1% to $8 billion. Note, average changes exclude changes from losses to larger losses. Average operating margins were higher by 0.2 percentage points to 5.5%. Medicaid plans posted a 1.9 percentage point gain to 4.3%, while commercial plans decreased by 0.7 percentage points to 6.1%. The health benefit ratio for all plans decreased by 2 percentage points to 82%. Note that Sherlock Company's calculation of health benefit ratios excludes the impact of favorable and unfavorable prior period reserve developments. When they are announced, we remove them from the reported expenses, and then we allocate them to the quarters in which the actual expenses took place. The average health benefit ratios for the Medicaid plans decreased by 5 percentage points to 82%. Molina posted improved health benefit ratios on improved performance in its Illinois and Puerto Rico Medicaid plans. Its Medicare business experienced improved medical trends as well. Commercial plans experienced a 1 percentage point decrease to 82%. The average administrative expense ratio increased by 2 percentage points to 12%. Medicaid plans reported a 3 percentage point increase to 14%, while commercial plans posted a 1 percentage point gain to 11%. Centene noted that its increase in its administrative expense ratio was due to expansion efforts in new and current markets. This includes its health insurance marketplace business. Also, the higher costs in all the plans reflected the restoration of the health insurance tax, which you might recall was suspended during 2017. Non-operating earnings increased to a gain of $472 million from $453 million in the prior year. Our calculation of non-operating income equals investment earnings as well as income earned in non-health lines of business less interest expenses. Medicaid plans posted non-operating losses of $11 million compared to last year's larger loss of $35 million. Again, that is net interest expense. Non-operating gains for commercial plans decreased from $470 million to $483 million in the interim quarter. Second quarter net earnings were higher for 6 of the 9 plans. Net earnings increased by an average of 352% and in total by 23% to $7 billion. As with administrative expenses, the year-over-year comparisons are impacted by the restoration of the health insurance tax for 2018. I want to close now by touching on a key environmental factor. We recently reported the results of the 2018 Sherlock benchmarking study for two of our most important universes. For the Blue Cross Blue Shield plans, per member costs of administration increased by 5.9%, sharply higher from the 0.6% growth in the prior year. Every cluster of expenses accelerated, but sales and marketing and medical and provider management were especially notable. For the independent provider-sponsored plans, per-member costs increased by 5.5% compared with a 2.4% increase in the prior year. In the case of this universe, while all clusters accelerated, corporate services jumped faster. This expense growth was the fastest since 2013, at the time of the implementation of the Affordable Care Act. We've been careful to hold participant universe and their product mixes constant for these comparisons. If you want some additional summaries, they are free of charge and they're available at sherlockco.com. There are many visions of how health plans will foster lower health care costs to consumers. They may involve more robust care management, consumer choice and price transparency at the point of care, or delegation of cost management to integrated delivery systems. Regardless of its vision, assuring that administrative costs are justified by their effect on the quality and efficiency of the entire healthcare production chain is central to the competitive position of every health plan. This is Doug Sherlock of Sherlock Company.
You've been listening to Doug Sherlock share his quarterly insights into the financial markets of health plans.